Hello, good morning, good morning, good morning. Close the door, please. Good morning, everybody. You're welcome. Thank you for joining. Thank you for joining. Share the video, share it so that we can get more people on the platform. Today we have a very interesting topic, and I had to bring back this topic because I get a lot of questions around this area. So we needed to talk about it. There's definitely reason to talk about this. I just want to laud you guys for coming on, for staying tuned. I know people are busy. The time schedule, we're having it on a Thursday at 10:30. That's not the best time for most people. They would prefer weekends, but if you cannot get it live, you can always follow the full version on deferred. You can see it later. So today we are talking on why real estate people, why real estate professionals tend to pay no taxes at all. Why don't these people pay taxes? I am excited about that topic, and I am going to try to lay it out there just the way it is. It's exciting because this is really why we come here. This is really why we want to build our own generational wealth. If we want to build generational wealth, we want to start by reducing that which is the most expensive bill we have, and which is taxes. Taxes are the one most expensive bill for any normal living citizen. And we have to look at ways of optimizing on those taxes, paying what they call our own fair share, not paying anything more, taking advantage of any incentives that we have in the tax law, in the tax code. That is why we are here, to educate people on these things and to make you know that they are out there. None of these videos alone is going to provide you all the information you need to make it happen, but it's going to highlight, it's going to help you be able, first of all, know that it's out there. Secondly, be able to use the right people. Thirdly, and also be able to understand what they are, because you just don't want to throw your thing at some tax person or whatever and then just depend on that person. You have to be able to tell that person that this is the way. Have some expectations. Those expectations are what are going to change the platform. Thank you. So let's start this by giving a word of thanks to the Lord for today. Today is Thursday. I just want to thank the Lord for giving us the strength, for giving us the energy, for giving us every ability to be here today to talk about these things. I know He's going to guide us through this, and I expect it's going to be, we're going to have a very helpful activity today. I thank you, O Lord. I bless your holy name. In Jesus' name I've prayed. Amen. 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 Let me put my glasses on. Okay. So, why do real estate professionals pay no taxes? Excellent. So the reason I brought this topic today is for a couple of reasons. One, this is tax planning. So people need to plan on their taxes. You plan your taxes beforehand. You don't just prepare taxes at the end of the year. You don't just come to the tax preparer at the beginning of a new year and say, okay, it's time to prepare taxes. There is basically everything about taxes is strategic. If you want to save on taxes, if you want to build generational wealth, if you want to build all of these things, you have to plan. And planning takes time. Some of these things we are talking about, they don't happen in a year. They don't happen in 2 years. You have to think about them on a strategic basis rather than just being tactical and just being timely. So number one, I've had a lot of questions coming through. As usual, I tell you guys that if you see me looking left, right, center, it's because I have different sets of people on different platforms. I have Instagram, I have Facebook, and I have people on Zoom as well. So at times I have to turn around and look at the different platforms as well. So lots of questions about real estate taxes. After what we did, I think it's a couple of weeks ago, still on how you can sell and make $1 million and still pay nothing in taxes. So a lot of questions came to me, and I said, okay, maybe we need to talk more about this because people have so much interest in it. And remember, there is no better place under the current legislation where you would be able to save on taxes than real estate. And I'll tell you why. Another thing is, there has been many years of people doing this, saving on, not paying taxes, doing this. We can do it ourselves. And that is why we come here to talk about this, so that we know what we can do and know that it's out there and take advantage of it. It's not only about talking about these things, it's being able to engage in it. And the first thing, I'm going to give you a list of strategies. I'm just going to go through some of those strategies. You know they are out there. And what are those strategies? I'm going to give you at least 9 strategies. There are about 20. There are about 30. There's a lot of strategies out there. But I'm going to give you at least 9 of those strategies today. So the first strategy, the first thing you want to think about when you're thinking about this is, just bear with me a second. The first thing you want to think about is you need a tax strategist. A tax strategist is one of the best way of planning taxes. People will say, why? Because that is the person who is going to teach you, who is going to help you how to optimize those taxes. A tax preparer is not a tax strategist. A tax planner is something closer to a tax strategist. A tax strategist is a person who is working towards taking you to where you want to go, towards optimizing. His primary objective is to help his clients get there. Let me tell you something. The biggest bill we have is our tax bill. The number of reasons people do not build wealth. The number one reason people don't build wealth is because they are taking this money and giving it to Uncle Sam. Uncle Sam does not need your money to do what they want to do. They don't. And I'll tell you why. The US, the biggest asset the US has is the dollar. They are able to commercialize the dollar. They are able to do everything they want. When the US wants to put a stimulus package for trillions of dollars, they don't go out telling people pay more taxes. They just go and create the money and put the money in circulation. Taxes are there for a reason. They are a major way of increasing the government spending. However, the biggest thing Uncle Sam wants us to do is to create businesses. When you are out there creating businesses, Uncle Sam is there to give you incentives to do that. The second thing is to employ people. When you employ people, what do? You're basically reducing what they call social unrest. People are busy. They are creating wealth. Wealth is created to people. There's a multiplier effect when you have people working for you. That's why the government of the United States and any other government is so focused on employment numbers on a monthly basis. So if you're out there, you're creating employment, you're doing exactly what the government wants of you. And what do? They give you incentives to be able to actively encourage you to do this. Another thing, they want people to invest in commercial real estate. Invest in commercial real estate. Invest in residential real estate. Build bridges. Build roads. Do all those things that government is not able to do, which they need to be able to revamp the economy, to push the economy. Once you are doing all these things, you're helping the country be at peace. You're doing what they call, you have social responsibility. And once you engage in those responsibilities, then you have incentives. And those are some of the incentives we are going to be talking about today. So I said the number one incentive, the number one strategy for you as a taxpayer. Number one strategy is to get involved. Do your taxes with a tax strategist. Somebody who is going to take you, who understands the tax laws, who is able to use those tax laws to avoid you paying taxes. That is number one. Number two, there is something that you call, I think we've talked about this. In the real estate profession, they already gave you a big thing. When you have a home and you sell that home, the rule is, there's something that they call Section 121 exclusion. It's topic 701, sale of your personal home. When you sell your primary residence, there are two main criteria. If you own that residence for at least 5 years, and you lived in that residence for at least 2 of those 5 years, cumulatively within the last 5 years, then if you sold that property and then you had a capital gain is taxed at the maximum 20%. You had a capital gain on the sale of that property, then most of that capital gain is not taxable. So that's number one. You get, if you're single, you get $250,000 of tax, capital gain. That is not taxable. Remember, capital gain is not how much, it's not the proceeds that you get from the sale. It is a difference between what you bought the property for, everything that you've invested in the property to date. You take the difference between that, that's your initial cost of investment, plus any property investment in that property. You find a difference with whatever you sold the property for. That difference is what you call capital gain. And that capital gain, if you made up to $250,000, is tax-free. If you made up to $500,000, if you're married, it's tax-free. So that is number one. There are many things around that, and we can talk about that. Somebody is asking me, what if if I already transferred the property? I made a video last time where I was saying that somebody came to me and he had a property which had appreciated, and that when he decided that he wanted to get another property, and basically just transferred the property into a rental. He transferred that property into a rental and got into a new property. And I said that was a mistake, because he could have basically taken advantage of that section 121 and then be able to avoid taxes for almost forever on that property. Because when you do that section 121, you can basically, you can sell that property to yourself. Basically, you can create a structure, an LLC, and then sell that property to that LLC. You own the LLC, you're selling it to yourself, and then you own that property. You make the capital gain on that property. And then, what does that do? That basically means you take advantage of the $500,000 capital gain that is non-taxed. And then you create what they call a basis now that has been stepped up. Because the new basis for that entity, the entity that just bought the property, the new basis is now the price at which you bought. And they would use that to take advantage of many other things. Depreciation, cost segregation. They can take that and even get access to refinancing and stuff. So you have all those things that you basically throw away if you just transfer the property to a rental without having gone through this process. That is something that you want to take very seriously, because there's a lot you can gain from there. Somebody says, what if I want to keep the home? I can still take advantage of section 121 exception. You can. You want to keep the home. I just told you how to do that. You can structure a property. You can structure a company and then transfer that property there. You're selling. You sell to that property. You make sure that property sells. There are processes to make sure that that sales goes off properly. It's not complicated. You talk to us, we'll help you go do that. You sell that property, and then the new entity owns the property. Even though you own that entity, you're still the ultimate owner of that property. Another big strategy is structure. Remember, I've told you this so many times. Structure is king. The way you structure your business determines everything. It determines a lot. If you structure your business, for most people who come to me as businesses, generally when you start a business, you just start a business. It's informal. I've told you so many times. You can start a business informally. But once you start making money, you want to think about the structure. You want to revise that structure. And structure, if you have many people just think, okay, I want to get an LLC. Great. LLCs are wonderful because they provide you something. LLCs, what they don't provide you, they don't provide you tax optimization. LLCs will give you what you call, asset protection. Because there's limitation of liability. The name in itself says limited liability company. There's limitation of liability. But what you don't get is that tax optimization strategy. You don't get tax optimization with an LLC. Today, guys, my office I don't have AC. So you're going to see me sweating a little bit. I don't know why, but there's no AC, but that's okay. So what I'm saying is that when you structure your company, an LLC by itself doesn't create tax benefits. However, you can create tax benefits with an LLC by doing something they call an election. When you elect to become an S Corp, you are avoiding something they call what? You are going to avoid a huge part of a tax called self-employment tax, which is 15.3%. So structure is always key. There are many different things we can talk about when it comes to structure, and we will talk about them in other and subsequent videos. I've talked about structure before, and I know that with the importance of what structure is, we can talk a lot more about structure. We are going to go through this, and like I said before, we are going to have a webinar coming soon. Not a webinar, there's a conference coming soon, and some of these topics are going to be delved into in very, very much detail. We'll look at that. So structure is key. LLC alone doesn't mean anything. It limits your liability when you're making money. It doesn't mean anything for someone who's not making any money. You cannot just start by saying, okay, I want an LLC, and then you think that you've limited liability. But limitation of liability, people only follow, they only come behind you if you're making money. So another one, another one, the next strategy, which is very, very important. The next strategy, you're putting me away from the camera. Okay. The next strategy is what we call, and this is very important, and this is really why most people go into real estate. It is called, there is passive activity losses. So you're making money, you own a business. Okay, now you're making money, you are on it. Let's say you are a doctor, you are an IT super guru, you are something, you're making hundreds of thousands of dollars annually. Let's say you made $400,000 a year from your W-2 job. And then you also invested in real estate, you invested in property. There's a rule called passive activity. You can use your passive activity. Your passive activity is really that real estate that you've invested in, because you're not actively involved in the real estate. So there are three categories of people when you talk about real estate. There is a passive investor. That's that person who just puts his money in a trust or puts the money somewhere, invests in a property, and then someone else is managing. He doesn't do nothing. He just waits for the end of the year, and then he has the details of what he has done during that year. That is passive activity. You are a passive investor. Then you can be an active investor if you make the decisions. If you are a decision maker on your real estate, you are an active investor. Then there's something that they call a real estate professional. That is really where you get the big. Let me give you the difference between this from a tax perspective. When you're a passive investor, you basically cannot take your profits, or you cannot take your losses that is coming from real estate, because real estate in most cases are going to they might make cash flow, they might create cash flow, they might create paper income, but for tax purposes, real estate are generally going to make a loss. For tax purposes, so that you're taxable, you're going to get passive activity loss coming from real estate. When you have passive activity losses, you cannot take that loss against your ordinary income, say your W-2 income. If you're a passive investor, you can only use that loss against passive activity income. So you can put in a bucket and keep carrying it forward for so many years until you get income, then you can cancel it. Nobody, I don't want you to be there. You don't want to be a passive investor. The second one is when you are an active investor. An active investor, there are rules around being an active investor because there are benefits of being an active investor. You are still that guy who is making $400,000 a year from your W-2. However, you know that your W-2 income is $400,000 a year, you're paying a lot in taxes. You need that passive activity losses to be able to reduce that. But remember, if you're an active investor, the threshold for income for an active investor is $150,000. If you are earning, if you're income, your gross, your taxable income is anywhere more than $150,000 a year, you're going to lose any benefit that accrues to you being an active investor in real estate. And how do you lose it? What happens? It means that you can only bundle it and keep carrying it forward until you get passive activity gains, profits, and then you can use those losses against them. You still get to keep them. However, here, if you are making anything, if your income is $150,000 or less, then as an active investor, you can take up to $25,000 according to the current tax code. You can take up to $25,000 of that loss that is coming from passive activity and wipe out your W-2 income worth. So you can take that passive activity losses because you are an active investor in real estate. And how do you qualify? You qualify simply by, you qualify to do that simply by being what? You qualify to do that simply by being by being active, in the sense that you make most of the decisions of your business. When you make decisions, then you can take advantage of that $25,000 to write off your W-2 income. Now, the best part of it is when you are something they call real estate professional. And real estate professional, thank you, Lisa. And real estate professional, what's a real estate professional? A real estate professional has rules. So if you are that same guy who is making $500,000 or $400,000 from your W-2 job, you have not been able to gain anything because you are not being able to benefit from being an active investor. However, you qualify as a real estate professional. You will qualify as a real estate professional if, one, you are investing at least 750 hours a year in that real estate activity. And then secondly, that number is higher than most of all the other activities that you're doing. There is a lot of nuances there. We can talk about that. We can look at your situation and tell you if you qualify for real estate professional. So if you are doing that, some people will tell me, okay, I can't qualify because I'm a doctor, I work all this time and I make $500,000 or $400,000 a year. Then you have your spouse. If you have your spouse, you can make your spouse qualify. As long as one out of you, the couple, qualifies as a real estate professional, then what do? Like I said, guys, my room doesn't have AC today for some reason. I know it's been announced here that there's going to be a storm coming, so it has already started affecting some of our lightings here. So when you are a real estate professional, you could make $1 million as income from other sources. And this is where all the big boys play. Donald Trump will tell you he's a real estate professional. All these other moguls, they are real estate professionals. They have invested heavily in real estate. And real estate is the one place where you could make $2 million, $3 million of losses. You could easily make $1 million of losses. All those losses, you made $1 million as your W-2 income. And then you went onto real estate and then you made a loss because you have invested, you have all these other, I'll give you different strategies that will give you losses. But you've made all these losses coming from cost segregation, from accelerated depreciation, from all the other things that you did in there. That loss, you can take that loss and completely write off that $1 million that you just made. Just because you are a real estate professional. So that is where most of these boys play. There's a lot more than that, and we can talk about that. That's the fourth strategy, and one of the biggest strategies that is there for real estate professionals. I already told you that, you must materially participate. Materially participate to be a real estate professional. We can talk about that. Materially means you're putting more than 750 hours a year in that activity. That qualifies you to be considered a real estate professional. Number 5 strategy. There's something we call cost segregation. Cost segregation is a very, very big thing in the real estate world. Remember, many professionals will tell you about cost segregation as being a very big thing. But if you don't qualify as a real estate professional, you don't really need it. It doesn't work. So that is why I tell you about structuring and strategy, planning. You know that you're already making money. You can plan yourself so that one of your spouses qualifies to be a real estate professional. And then you can take advantage of this. When you are a real estate professional, you can do cost segregation. Cost segregation, what does that mean? What does that mean? Cost segregation simply means that I am a real estate professional. I'm invested and bought the property. When you buy a property, for a commercial property, depreciation of that property that is allowed for you because you're a business. Remember, depreciation only happens if you're a business. You have a business, you are a real estate professional, you are a real estate person, and then you own a property that is out there for rental. You own a property that is out there as a commercial property. Rental properties will be depreciated straight line over 27.5 years, according to the current tax code. Commercial properties are depreciated straight line. You can write off the cost of your investment over 39 years. However, cost segregation is, it allows you to go into a property that you bought for $1 million, for $500,000, for whatever you bought it for, and then basically break down the items that are in that property. When you buy a house, there are cabinets in there. There's the roof in there. There's things that you put in that house. There's carpets. There are carpets on the floor. Those items are items that are going to be depreciated. They are going to be used up within 5 years, within 3 years, within 2 years. They are going to be used up within 5 years. So basically, with cost segregation, you are able to break down the whole property into different buckets. And then you can accelerate the depreciation of those items on a cost segregation basis. You take those items and then you can accelerate the depreciation based on their lifespan. That is a huge, huge thing. But if it gives you a loss of $1 million and you are not a real estate professional, it doesn't really benefit you. You have to put it in that bucket and keep it and wait that when you make profit, when you make a benefit on there, then you can have it. So basically, cost segregation is one of the biggest available things in real estate. Another strategy is Section 1031 exchange. I did a video on Section 1031 exchange. This by itself is one of the largest by a mile for real estate professionals. It's largest by a mile for real estate professionals. 1031 exchange simply means that you keep pushing it until you die. You keep pushing it, you keep rolling your taxes over until you die. So what this does is that I have a property. I own a property, which is a rental property, a business. Remember, Section 1031 is for businesses. It has to be a rental property or commercial property, whatever it is. So 1031, with the current tax law, they tried to cancel 1031, but it couldn't go. They removed 1031 on certain different types of property, but not on real estate. Real estate, the way it works is that you bought a property for $200,000 20 years, 50 years ago, or 10 years ago. And then today, that property is worth $1 million. There's a capital gain, which is the difference between your cost and what you sold it for, of $800,000. That $800,000 will be taxed at capital gains tax rate. You have to give at least, on that $800,000, you have to give 20% of that money to Uncle Sam. So what people do, nobody wants it. I don't like it. I don't want to give that money to Uncle Sam. So why do I do? What do I do? Basically, what I do is what Section 1031 exchange does to you. It allows you to basically, once you take that money, you go and invest it in another property. It's a like-kind exchange. You go and invest it in another property. Either 1, 2, 5, 10, or 20, 30 properties. As long as you invest, you buy other properties for more than what you sold that property for. So remember, you're buying properties in America. Even though you sold that property and you had $1 million or how much dollars you made, you are not going to just go use that money to buy a property. Where I come from in Cameroon, you have to go and spend the money, pay the cash. In America, if you sold a property for $1 million and then you netted in your cash, they paid you maybe $700,000 because you had some mortgage that was remaining. That's $700,000. If you even take only $200,000 of that money, you can go to, you put a down payment on a property. You put $200,000, 20% of a $1 million property. So if you took that money, you can buy 5 different properties with it. You can buy 10 different properties with it. You go and buy more properties with it. As long as you're investing more than how much you collected, you got from the sale of your previous property. Then you've just rolled over. It's an exchange of that property. You're not paying no taxes. The problem here is that there's a time bound to it. So if you sold the property within 45 days of the code, within 45 days, you have to already have identified the property you're buying and close it within 6 months. So 1031 exchange. And the big thing about this one, I mean, I have clients who have been doing this for years. They just keep doing that exchanges. They keep building their portfolio on these exchanges, and they are never paying no taxes on all the gains they are making. Remember, as you keep accumulating that gain, the day you sell it and then you don't do that exchange, you're going to pay the taxes for all the years. So how do you do it to avoid it? There is something that you basically do the exchange until you die. When you die, the first property that you bought was probably $100,000. But because you've done exchanges over the years, and you now have real estate property for maybe $5 million. So the value, when you die, whoever is your heir, the inheritance is going to be the basis of the inheritance will be a fair market value at the date of death. The fair market value of your assets, that asset that you bought the first one for $100,000, the fair market value is now $5 million. So basically, you just transferred it to your son or to your daughter. You transferred $5 million the day you die. Once you transfer that, that becomes their cost basis. They didn't pay a dime for it. That becomes their cost basis. And as their cost basis, what do? If they turn around and sell it for that $5 million, guess what? There is no tax. There is zero tax. So you just transferred wealth over time. You built from $100,000 and you made $5 million that you've transferred to your children, and they are sold it tax-free. There's no tax. So that is a huge one that's being done. But remember, the caveat here is if you had sold that property, any of those properties, 1 month before death, you would have paid the taxes between the difference of that $100,000 that you bought the first property for and the $5 million. So $4.9 million you have to pay taxes on. So you just push it, roll it over until you fall. When you pass, it's going to be transferred to your children tax-free, because that's what you call step-up basis. And then the basis becomes the new fair market value, and then you can sell it and get the money out tax-free. Huge. This is huge. So, having said that, let's go to the next one. What is the next strategy? Strategy number 7, accelerated depreciation. Depreciation is one of the biggest ones. The Tax Cut and Jobs Act of 2017 just enhanced this. I have talked about cost segregation, which is a huge one. I've talked about, there's something called Section 179. Section 179 allows you to be able to write off an item that you bought for over $2.5 million. You bought it for $2.5 million, up to $2.5 million. Any item of business property that you bought within that threshold, it allows you to write off up to $1 million immediately. Section 179. So imagine, folks, you have You made $1 million on your W-2. You can basically, if you're doing business, we can use that and then write it off. But there are so many things you can do there. There's also bonus depreciation. It allows you to create buckets and be able, instead of writing something over 25, 27 years or 37 and 39, 27 and a half years or 39 years, you can bring it down and write it off right now. So that is one of the biggest things about, so accelerated depreciation is it's just a big thing in this industry. And that's why most people, they never pay taxes. Strategy number 8. In one of my videos, I told you something. I said, and some people called me and said, oh, what do you mean by that? I said that as long as there is something called debt, as long as there's something called cost segregation, as long as there's depreciation in the tax code, I don't see how a real estate professional will be paying taxes. And that is exactly what I meant, and I still mean it today. So debt, you remember the guy called Elon Musk? That's the richest person on planet Earth. That guy hadn't paid taxes for more than 20 years, for many years since he started his business. It's not until 2021 that there was call from the public, there was public opinion asking, why would a richest man on earth? Because people didn't realize he wasn't even the richest man. It's in 2021 that when all his share options that he had, when they vested, then people realized that this guy is now worth $200 and something billion. He was richer than everybody. And people were like, okay, if he's richer than everybody, why he's not paying any taxes? That this guy decided by himself that, okay, he sent a text, he tweet for people who follow him. He sent a tweet and said, maybe I should pay some taxes. So he makes a decision on paying his own tax, on paying taxes. That's the richest man in America, on the planet Earth. He decides when he wants to pay taxes. So he tells you that maybe I should pay some taxes. And what did he do? He decided that some of those options that had vested, that he now belonged to him, he went and sold a few. And you know how much he paid in taxes when he sold them? Because it's on when you realize gain that you pay. He paid $15 billion in taxes in 2021. And that's just a portion. He just decided that he wanted to do it. You can do it too. Jeff Bezos, last year, 2021, he paid on his income. He made over $4 billion last year. And this is Washington Post. Over $4 billion, and he paid 0.98% in taxes. Why? Because he uses his strategies. He uses a tax strategist. He uses somebody who knows how to do these things to make them happen for him. Donald Trump, our former president, he told you that he was a smart guy, and he meant it. And I know he's a smart guy. He never, in 2017, when he became president of the United States, was it 2017 or 2016? He paid $750 in taxes. He had made millions and millions of dollars from apprentice, from real estate properties, from doing all sorts of, from those things that he did, women's and whatever. He paid how much? He paid $750, $750, not $750,000. He paid $750 in taxes. And that is because he knew that he was going to be he wanted to be the president of the United States. So he needed to pay some taxes. Because for the past years, for many years, he was never paying no taxes. And that's because he's smart. He uses the services of tax strategists to make sure that he doesn't pay taxes. Not tax preparers, but tax strategists. I can tell you so many strategies, but I'll just stop here. There's another one, self-directed IRAs, self-directed 401ks. When you have a 401k, someone else, there's an asset manager, there's someone who is helping you manage your 401k. Invest with your money, and then they give you the returns based on what they have realized. But you can, the same thing that is happening to a 401k, you can decide that you are directing your 401k, you are directing your IRAs, and then you can invest in real estate and take all the benefits that we're just talking about. So there's a lot we can, there are all other structures. I told you there are thousands and thousands of, there are not thousands, there are many, many strategies that we can put in place to avoid taxes. And I know, and I hope that we can take advantage of this. I really think we can take advantage of this. Let's make sure we do that. Like I said before, we are having a conference. We're having a conference next month. I know Lisa and the team, they're working on that. And this conference is going to be held here in Houston. We want to teach people on how to build how to avoid taxes, but also how to build generational wealth tax-free. We are experts. We are really focused. We spend all our time looking for ways on how to help our clients optimize their taxes in the most legal way possible. We are not just tax preparers. If you came to me to prepare your taxes, you get the preparation. But if you came to my office that you wanted tax planning, or you wanted us to help you as your tax strategist, we are going to help you avoid taxes. But that takes a strategic process to make sure it happens. Again, I want to thank you for being here today. I see so many messages coming through. I thank you all for being here. I know we are all busy people, and may God bless you. Call us, follow up.